Hello and a warm welcome to another edition of Econoday Unplugged. It's Tuesday, the 8th of October 2024, and on today's podcast we have Terry Sheehan on the East Coast, Max Sato in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. So last month, the Fed surprised investors by cutting its funds rate target by an unusually large 50 basis points, a move widely expected to be matched by the New Zealand Central Bank later today. Next week, the European Central Bank, having strongly hinted in December that rates would be on hold until at least December, now looks very likely to ease by another quarter of a percentage point. And only a few days ago, Governor Andrew Bailey suggested that future rate cuts by the Bank of England could be a bit more aggressive. Additionally, in China, the authorities have just announced the largest monetary stimulus since the pandemic. All of which begs the question then, are we now in an environment in which many central banks are looking to return policy to a neutral stance rather faster than previously planned? So, Terry, let's kick off with you then. 50 basis points from the Fed in September. I think around what I saw from the surveys, about 90%, if not more, of forecasters were expecting only 25 basis points. So, why the bigger move?
Well, I was personally expecting the 50, not the 50 basis point move, but the 25. But it seems that from what Chair Powell said, that the idea was to help stop the cooling in the labor market so that we would get the employment conditions to stabilize about where they are now.
So does this mean that we're starting to get more of an emphasis now on the labour market and saying perhaps unemployment rates than we are inflation? Are they no longer so worried about inflation?
Well, I think they are no longer so worried about inflation, but prior to the release of the September employment numbers, the labor market data had generally indicated that conditions had softened. They weren't weak, but they had softened a great deal. So, and it seemed to be accelerating just a little bit. So the Fed took preemptive action with the 50 basis point cut. But it may not have been necessary given that the September employment report came in well above expectations.
Yeah, okay, well, let's sort of talk about that now. I'm just looking at Econoday's relative performance index, which gives an idea of how market expectations have been faring against what actually happened. The RPI has been consistently in what we call positive surprise territory for the US for more than a month now. So I guess you can say in some ways that was almost confirmed in the labour market report as well. But the general picture of US economic activity, say for more than a month, has been stronger than expected. So how did perhaps the employment report pull all that little lot together?
Well, the employment report with the over 250,000 increase in non-farm payrolls was about double what the market consensus was. But at the same time, if you look at it in a wider context, this was actually a pretty average report for what we've been seeing in the past year. It was good job growth, relatively little sign of layoff activity, wages rising steadily. So it was pretty consistent with a U.S. labor market in a U.S. economy that is expanding modestly.
Okay, now, as you're always keen to point out, we can't just take one month's worth of labour market data, or indeed any data at face value. It's got to be seen in perhaps the context of a number of different reports. As it currently stands, do you think 50 basis points, another 50 basis point cut is possible when we get to the next FOMC, or do we need now a much weaker employment report next time for that to happen?
I think some of that's going to depend on some other things that are going on in the US right now. Mm-hmm. Just had a major hurricane blow through and cause widespread devastation in some of the southeastern states. We have another one on the way. While any one given weather impact is probably not going to drag down growth overall, if we have a series of hurricanes, while the impacts are going to be mostly regional, it's going to be a big region, and the Fed may feel it's a good idea to front load the already forecast rate increases. So it is possible that we will see a 50 basis point cut at the November meeting.
Okay, interesting.
But
of course,
to add to that, I think it pretty much eliminates the possibility of another rate cut in December.
Right. Okay. Fair enough. Of course, before then, we're going to get an inflation update on Thursday. What's expected there, and what do you think is necessary to change market perceptions of what the Fed's going to do next?
Well, I think we'd have to see some real deterioration in the GDP to change the outlook for the economy as a whole.
Mm-hmm.
I think that overall we are seeing incremental improvements in inflation. The all items CPI is looking pretty good in terms of returning to the Fed's 2% inflation objective. Core rates, not quite as much. And related to some of the things that are going on in the Southeast, we're going to probably have massive demand for things like replacement motor vehicles and appliances, for building materials, for all sorts of infrastructure items. Businesses are going to have to restock. So there may not be as much evidence of declining prices in a period where demand is going to fluctuate a bit higher. That's probably not a long-term effect. So I think the Fed is pretty much on track in terms of the underlying inflation conditions, and are looking for another report in October that will show another step down for upward price pressures.
Okay, and let's quickly just sticking with headline inflation, I guess. And obviously, in the light of some of these recent Middle East developments, we've seen a fairly sharp pullback in oil prices, they're up about 12% or so, I think, the benchmark numbers over the last month. If we continue to see that happening, we start to see prices, dollar prices going to $80 a barrel again or something like that. Is that going to have implications for what the FOMC does?
Probably not at this point. They do tend to consider energy prices as one of those short-term volatility issues. It will depend on if oil prices go back up and stay there. But as far as things like the healing of the supply chains, most commodity prices have come down considerably. We are finally beginning to see the easing in home prices. So otherwise, I think the inflation outlook looks pretty good.
Okay, and my last question for you then. Looking at where we stand at the moment in terms of what the Fed funds target, 4.75% to 5%. US inflation, at least for headline numbers, what we're talking 2.5%, I think, isn't it? So real rates of over 2%. Have you got any idea where the Fed might want to see real rates settle? Are we talking at 1%? Are we talking more than 1%? Do we have any idea of what the Fed now regards as being if we so-called the equilibrium rate now for US economy?
Well, the forecasts show a longer run expectation for the midpoint of the Fed funds target range to be 2.9%. So let's say 3. So I think that is probably a pretty good figure to work with right now.
Okay, so something around 1% in real terms. Okay, brilliant. Anything else you'd like to add, Terry?
Oh, in real terms, sorry.
Yeah. Anything else you'd like to add?
No, I think that's about it.
Okay, brilliant. Tar, as ever, muchly for that. So let's just move across to Mr. Sato. Max, Bank of Canada, 25 basis point cuts in June, July and September. So along with the Swiss National Bank, they've been at the head of the central bank easing pack. Now we've seen the Fed do 50 basis points. Is there any reason for supposing the Bank of Canada won't follow?
I think we have a slightly different economic climate here, and maybe political climate too in Canada compared to what's going on south of the border. I think Governor Mack and his team, they've been pretty careful not to upset the balance. And look at the inflation now nicely into the 1 to 3% range, up 2%. So they won't upset the balance. So I think the Bank of Canada started raising rates a little earlier than the Fed did, which was back in March 2022. So we started cutting rates a little earlier, and that makes sense to the public and the markets.
Okay, so we're looking at 50 or 25 basis points next time.
It depends on what's going to happen to the growth rate and what BMO chief economist Doug Porter would call random number generator, our jobs data. But generally, I think gradual approach may be better for Canada.
Okay, interesting. But either way, rates coming down in Canada as well. Right, so compare and contrast time, of course. It's back to your favourite part of the world, Japan. Right, well, I don't know, you're going to summarize it all, but clearly we've got a new prime minister now who, as I understand it, despite supposedly being seen as something of a policy hawk, reportedly now thinks that the economy is not ready for further interest rate hikes. So can you kind of fill us in what the new picture looks like in terms of, politics briefly, but really what they mean for policy in Japan now?
I think, Ishiba has been around, and he's not a liberal, but a conservative, but still, he likes to create healthy debate within the party and with other parties. So he's a steady hand, and I think Japan now has a bit of a stability at last. And he's a military and policy kind of a self-claimed guru, and people think so too. And maybe, the investors, market people are reading too much into daily comments from Ishiba or his ministers. They don't really mean, that the bank shouldn't raise rates. They're just saying what the Japanese government has been saying. We're not out of the woods yet in terms of deflation, which may or may not true. But the Bank of Japan's own view is we are out of deflation. Okay,
can I just quickly interrupt? Do you think he's, as you say, we all know how the markets leap on anything which a leading politician or a central banker says and invariably take it too far. Do you think, say this alleged comment anyway about too early to put interest rates up, do you think that's something to do with politicking ahead of the general election on the 27th of October, isn't that?
You're talking about the impact of the
Ishiba trying to basically get his vote count up by, kind of intimating to the central bank, to be seen by the population. Oh no, we don't want rates going up.
Let's put it in the bigger picture.
Okay.
When 2 prime ministers ago, Abe had a long administration, and basically it's almost like changing the constitution. Okay, now we want 2% inflation target, clearly, written in stone, and we're going to do anything to push for it. But then he didn't really mean that. And Abe just wanted to use it to win elections and push for his own pet project of a change in the constitution. So when Abe is gone, all the politicians are less interested in achieving 2% target, but because it was never possible. Then Kuroda had to still carry the torch, and then he's gone. Now, the new governor, Ueda's mission is to correct the excessive monetary easing. So he's been doing his job. And so it is still, the direction is raising rates, but look at the rates, still like at a snail pace and even close to zero. So of course, mortgage holders, new home buyers, small businesses, they would complain, no, I can't do that. But I think that the direction is, of course, gradual rate hikes, and hopefully they wouldn't repeat the same mistake of not raising rates fast enough to at least to 1% long-term, the yield curve is so flat. Short and long, not really different, but short-term 1%. Within the foreseeable future. Otherwise, we might get hit another pandemic or global financial crisis. So that's where we stand.
Okay, so we know we've got all the politicians and the central bankers perhaps saying what they hope's going to happen anyway, what they kind of plan to happen. What's the actual economy itself telling us at the moment about what's likely to happen?
If you take a look at the latest, let's look at household spending. It's been sort of up and down month to month, and then over a year ago, it's still a little bit weak. As you know, that it accounts for about 55-6% of the GDP, and not really a strong or weak economy. So we've seen this forever in Japan. Like kind of a lukewarm, wobbly recovery.
Okay, so as always, I'd like to ask, when do you think interest rates will finally go up again?
Towards the end of the year, I mean, at the end of the year, early next year would be nice. I mean, nice meaning, not going to upset anybody, and then still stay on course. Of course, weather doesn't want people to think that he's not going to raise rates, so he has to keep that expectation up. But at the same time, he would say in the same sentence, but we're not in a hurry. So that's where we stand.
Achieving balance, such a good idea, but so hard to do. Okay, Max, anything else you'd like to add on Japan?
Yeah, I was in Japan, in Tokyo and Osaka last month, and I met my sources and contacts, and I think, the Bank of Japan people, maybe government people too, they wanted to see the correction of the very weak yen, but they didn't want to happen so fast. But of course, it's really up to what the Fed's going to do. Japan's kind of a, really in a kind of a no change mode right now. So I think policymakers are a little bit worried about reversal of the weekend towards maybe too strong a yen, but see what happened. Now we stand at about 148, and they lost their, the value in the end. So that may or may not dictate the policy decision. It's probably not, because they just have to stick to the process of correcting the past excessive monetary easing. And one thing I could add is I stayed at different hotels, and labor shortages are serious. We used to get great services at hotels, and now it looks like the students are working, and they don't know anything. If I ask questions, I know better than they do. So that's a serious issue right now, and that was feeding nicely into the wage hikes. But after the summer bonuses, the rate is a little bit slower. So that's what that might concern Bank of Japan people.
Okay, excellent as always, Max. So that's it for you then. Right, let's move across to Brian and China. Brian, to China then. And I guess there's much to talk about there. So back end of last month then, we got the announcement of, a bazooka monetary stimulus package, the largest since the pandemic. Stock market promptly recorded its steepest single-day rally since 2008. So we've had these stimulus measures being delivered before, and they signally failed to convince investors. So what's different this time?
Yeah, I guess it's more the scale and the breadth of the package that they did announce, back last month. Just a combination of cuts to the reserve requirement ratio, the repo rate, and also direction to banks to cut mortgage rates going forward as well. So that plus a few other bits and pieces in the package definitely represented a bold and definitive move by officials, and that was clearly, I think, driven by some of the data that we have been seeing in recent weeks and months. Not so much the activity data. The last month's activity data numbers were reasonably strong, but we've just seen a resumption of pretty severe weakness in property prices in particular. Back into negative territory for house prices over the year, and that seems to be the thing that prompted this move by Beijing. We've also had some follow-up just today on the fiscal side.
Yep,
just
ask about that. Yep.
Yeah, so they're talking about something like around $28 billion US. Some of that is just sort of front-loading spending that they're going to do in 2025 anyway, but some more of it is local government construction projects and the like. So that wasn't probably as substantial as the monetary news that we had last month, but obviously it's just a cumulative response by officials, and they're hoping that will have a bit of an impact on the data going forward.
Okay, well, one thing I noticed, just quickly going back to the central bank, do you think they've actually well, I suppose it's just reflecting what's going on in the economy and inflation and so on, but they came out and effectively introduced some form of sort of forward guidance when they intimated that, depending on market liquidity later on this year, they're prepared to come out and cut banks' reserve requirements again. I think this is pretty unusual for them to come out with that kind of a statement, isn't it?
Yeah, I mean, as we know, they're normally very opaque and tight-lipped. So that definitely was interesting, and I think probably was just an attempt to perhaps get a little bit more bang for their buck by foreshadowing some extra moves later on, hoping that might drive a bit more confidence in the share market. And but they definitely did get a pretty solid response in equity markets when they did this. So that might have been some of the thinking behind it. But I wouldn't necessarily be expecting that sort of transparency to continue going forward.
Okay, fair enough. And I guess in a nutshell, do you think this package is enough to ensure that they hit the 5% growth target this year?
Let's say yes, but obviously, it still remains to be seen just how much of a drag the property market is going to be, and consumer spending in particular. We have seen some reasonably solid industrial production growth numbers, and in recent months, but the retail sales spending does suggest that the housing market is still a bit of a drag on consumer spending. And if we just go back to last week, the PMI numbers were still pretty soft. So it's going to take a while, obviously, for that to feed through. So whether that's going to be quick enough to actually impact the annual numbers for this year remains to be seen.
Okay, fair enough. Right, let's move your immediate neck of the woods then. RBA, I guess, amongst the most hawkish, well, at least dovish of central banks of recent times. But I think it's still fair to say there's no sort of discussion of rates going up. So we had the minutes of a September meeting a short while ago. Anything offering that in terms of, chances of a rate cut before year end?
No, not at all. No, it's
right.
They're still very much trying to hose down any suggestion that a rate cut's coming anytime soon. And most people now are sort of definitely talking about sometime after Christmas. So we've only got I think 2 more meetings between now and Christmas. I don't think that's on the cards, and they've been pretty clear about that for a good 6 or 8 weeks now, and the minutes today just sort of reaffirmed that. So they did show, in fact, that they looked at scenarios today at the last meeting where they might actually have to tighten rates further. So they're trying to really just hose down any suggestions that a rate cut's coming soon, and they're just highlighting that inflation is still very much the main focus, and they're not happy about sort of the pace of disinflation.
Okay, well, nothing out of Australia. And what about New Zealand? We had that surprise cut, 25 basis points, remember rightly, in August. But it seems now as if most folks are talking about a 50 basis point reduction this week. So what's changed?
Yeah, well, that's just highlights the difference that we do have between Australia and the RBNZ at the moment. They are sort of further down the road than Australia is. They started hiking earlier and a bit more aggressively than the RBA did, back at the start of the cycle, and that means, perhaps they've had more success in getting inflation lower and being able to start pulling back on some of that those policy, the policy tightness. That said, the other issue is that they have had some pretty soft GDP numbers, and that's obviously impacting what they're thinking as well. So that was definitely something that they highlighted when they did that surprise rate cut at the last meeting, and that's what's driving expectations that it could be as much. They might even go to 50 basis points later this week. There's still a few people saying it's somewhere between it's a toss up between 25 and 50, but the consensus seems to be that they want to start aggressively cutting rates to help support growth now that that's fallen off, and in response to their sort of greater confidence about the outlook for inflation.
So do you think now, there's a lot of talk in markets all to do with central banks now, and how quickly they should get down to sort of the equilibrium or neutral level of interest rates, if you like. If the RBNZ comes out and cuts 50 basis points this week, do you think they could do another 50 basis points as soon again as when's their last meeting? November, isn't it? Could they do 100 basis points between now and year end?
We'll get a better sense of it, obviously, in terms of what the tone of the statement and any other sort of comments we get out of this week's meeting. So it's probably a little bit premature to be very precise on how fast they'll go, but they're clearly indicating that they've turned the corner, and that there is now a path towards lower policy rates going forward. The exact pace of it, I think, is still a little bit too early to judge, but if we see 50 this week, they might think, okay, we sort of can now sort of scale back and just do steady 25 cuts going forward, but it just depends, I guess, on what the numbers we see between now and the next meeting.
Okay, just quick before we leave New Zealand, Kiwi dollar, that fell the best part of 3% against the dollar last week. I guess partly in anticipation of a big RBNZ rate cut this week. Is the exchange rate going to be a factor if they do 50 basis points this week and the exchange rate continues to weaken? Would that have any kind of implications for what they might do at the next meeting?
Oh, definitely. They don't want a free fall in the New Zealand dollar, so that will definitely play into their considerations and deliberations. But they are also, I think, more, as I said, they're more confident about the inflation outlook. So even if they do get a bit of exchange rate weakness as a result of this, reassessment of the monetary policy outlook, they're probably factoring that into their forecast about how inflation's looking, and so that's going to inform their decisions about just how aggressively they can cut policy rates.
Right, fair enough. Okay, India then. We've got an RBI meeting. There's lots going on this week in your part of the world. Reserve Bank of India this week. They've had their rates on the whole for well over a year now, haven't they? So any chance at all of a shift this week?
I think they'll be the outlier for me this week in terms of staying on hold. Not a lot of, I think, cause for them to shift policy at the moment. They're still, I think, reasonably happy with the growth numbers that they're getting. They've come off a little bit if you look at the PMI surveys that we had last week, but still sort of in the high 50s. So still indicating pretty solid growth in both the services sector and the manufacturing sector. So I don't really think that's a consideration that would lead them to think, okay, we need to start easing policy. And then, on the inflation front, they've got inflation now sort of close to where they want it to be, but they got it below. Where is it? It's 3.65 was the last thing. So that was just below the midpoint of their 2% 6% range, and it's been there for 2 months in a row now. So they're going to be very happy with that, but they always say we have to be mindful of the impact of weather on the short-term volatility in inflation. Right. And so I don't think they're going to move away from keeping policy pretty tight where it is for the time being until they have a sort of a clearer view about just how the inflation outlook is going to be.
Okay, well, before I leave you then, anything else from your sort of regional coverage?
Well, no, we do have one more central bank this week as well. Don't forget Korea. So we have the Bank of Korea in the week as well. And so they are expected to cut rates as well. So that is something that has been foreshadowed in the last 2 or 3 meetings, at least the last 2 meetings. They've been talking about, okay, we've got inflation trending lower and heading in the right direction. So in upcoming meetings, we are going to actually consider whether we can cut rates. And I think there's a good chance that we will see that this week. Markets are pricing in, I think, a 25 basis point cut. That will be the first cut the first change in policy rates for quite some time, first cut in several years. So that's another indication that we are seeing a shift in policy in this part of the world.
Okay. Anything else, dare I say?
No, that's it. That should keep us busy enough.
That should keep us going for a little while. Okay, great. Thanks for that, Brian. All right, then let's move across to Europe now. And the European Central Bank, which makes its October policy announcement next week. And expectations for that have shifted quite significantly since the last meeting in September. Economy-wise, well, Europe's still showing no real signs of growth. Big problem still with Germany, where most of the data are pretty well uniformly weak. Even the French statistics body now is forecasting a contraction in French fourth quarter GDP after a temporary boost it got from the Paris Olympics in August. Crucially, too, the region's inflation rate is still falling, with the flash headline rate down 1.8% in September, moving below the 2% target for the first time since the middle of June 2021. The core rates have also slowed again. The narrowest core is down at 2.7%, and that's its weakest mark since the beginning of 2022. A number of council members have actually come out, despite the fact that they're probably not really supposed to, saying that they expect interest rates to be cut next week. All that said, it's not probably a done deal. It does look like it's going to happen. It's certainly a good deal more likely now than just after the September meeting. But the Hawks won't be overly happy about further rate cuts without having a new set of inflation forecast from the central bank first, and they're not due until the December meeting. So probably means that most will see a 25 basis point cut, and the idea of something like a full 50 basis points a la Federal Reserve seems pretty improbable at this stage. As far as the UK is concerned, superficially over here, I guess the economy still seems to be doing pretty well. The second quarter PMI composite output index averaged 53, so comfortably above the 50 growth threshold, and indeed well ahead of what we're seeing coming out of continental Europe. But in recent months, it's not been a particularly good indicator of overall activity. In fact, looking at the monthly GDP figures, and we'll get the August update for those on this Friday, it's only expanded once since May, and that was in May rather, and that's its first increase since the first quarter. June and July were only flat, so really it does seem as if real economic activity has lost a fair bit of momentum over the course of the last few months or so. Inflation is doing okay. Inflation, the headline rate in August was 2.2%, unchanged. The core rate, though, jumped to 3.6%, up from 3.3%. But certainly if we put sort of straight lines through these things, underlying inflation is trending down. So I guess if you pull it all together, as far as what's going to happen to the Bank of England vote, which we won't get until next month, it's probably at the moment still anyone's guess. The September vote for no change was fairly clear at 8-1. But of course, we have had Andrew Bailey, the governor of the Bank of England, suggesting that if inflation does keep coming down, we might even see larger interest rates and cuts than we've been used to. So markets have grabbed on that as being perhaps a potential sign we could see rates coming down again in November. Key to the final decision will be in many ways next week, when we'll get the September CPI and the new labour market reports. If they come in on the soft side as well, then certainly that would increase the likelihood that we will see bank rate being cut from its current 5%. I'll round off quickly with Switzerland, where, again, like so much of the world at the moment, it looks as if rates are about to come down before too long. Got a new chairman there, Martin Schlegel. He took over from Thomas Jordan at the beginning of the month. He's already come out and talked about downside risk to what is already low inflation. In fact, Swiss inflation in September was just 0.8%, and the core rate was only 1%. The economy is still quite sluggish, the Swiss franc strong, so pull it all together and it does seem as if there's an excellent chance, as things currently stand anyway, that we'll see what would be a fourth straight cut by the Swiss National Bank. Probably no more than 25 basis points, but I guess 50 basis points must be a possibility if we were to see inflation continue to come down. But say likely we'll see that coming through at the December monetary policy assessment. Okay, then, so let's end it here then as far as this podcast is concerned. Lots going on in the world of central banks. And of course, with a US election just around the corner, market volatility levels look set to stay high for some considerable time. And indeed, obviously, we need to keep an eye on what's going on in the Middle East as well, with oil prices well above where they were just a few weeks ago. More of the same there, and that could start messing up some of these forecasts for lower interest rates as central banks have to start getting concerned about headline inflation rates again. So anyway, it's still the data that matter most. So do make sure that you keep up to date with all the key indicators in Econoday's global economic calendar. On behalf of Terry, Brian, Max and me, thanks as ever for tuning in, and we all look forward to seeing you again next time. Bye for now.